What's the fastest way to make a small fortune? Easy. Start with a large fortune and then trade options on stocks. What are options? If you visit WallStreetBets on Reddit, you might think options are the quickest way to donate all your money to Wall Street. Wait, you haven't heard of lost porn? Here, let me introduce you guys real quick. We're going to start with an easy one. This intrepid options trader currently has about $2,000 in his account. However, you can see that he's lost $14,157 or 88% of his account in the past year. You can see that everything was pretty flat when he first put his money in. He was probably just doing some basic trading, and here's where he turned on options. And this is what we call crazy volatility until eventually he just became so bad at it that he's lost 88%. So this is a starting point. Get ready now and hold on to your stomachs because these are just the starting points. Oh my God. I mean, oh my God. So what's going on here? This guy has $5,000 in his account, and in the last week, he lost $337,000. That's what we call a very, very bad trade. And now for the big one, as if $337,000 wasn't big enough. I don't even really know where to start with this one. I mean, oh my God. Oh my God. You lost $1 million in a week. You had $1.25 million. I'm pretty sure at that point you could afford to have someone do this for you, or at the very least just send me the $1 million and I'll light it on fire for you. Believe it or not, the original concept behind options was to save investors money and for brokers to sell degenerate day traders garbage in exchange for money. Here's how they work. Let's say you think Rivian couldn't possibly report another negative earnings report when it reports next June. Spoiler alert, Rivian totally can disappoint. However, that's a story for a different video. With the stock currently trading at $38.05 a share, you could shell out $3,805 to buy 100 shares of the stock. Or you could buy the Rivian June 17th $35 call option for $10.10, which gives you the same exposure. What's going on here? An option might look complicated, but it's really quite simple. First, you've got the ticker. RIVN is Rivian, of course. Next, you've got the expiration date. In this case, June 17th of 2022. Finally, you've got the strike price of $35. This is a call option. Buying this option means that you will have the right to buy 100 shares of Rivian at $35, no matter how high the price goes between now and June 17th. If this was a put option, you'd have the right to sell 100 shares of Rivian at $35, no matter how low the price goes between now and June 17th. Since this is a call option, you get the right to buy the shares at the strike price, in this case $35. If Rivian skyrockets to $100 by June 17th, you still get to buy those Rivian shares at $35. You can then turn around and sell them for $100, pocketing the $65 difference as profit, or you can sell your option before expiration for a value that has increased as if you owned 100 shares of Rivian, minus the cost of the option. Options are priced based on the implied volatility of both the stock and the market. In other words, if there have been huge price swings in the market, options will cost more. Since lately, the markets have been acting like a Labrador Retriever puppy who hasn't been walked in 2 weeks and just discovered his owner's cocaine supply, options are more expensive right now than they are when volatility is low. Because of this, the cost of these Rivian call options is $10.10. However, in order for this trade to break even, you'll need the stock to trade above this price by the amount of the cost of the option, in this case, $10.10. In other words, Rivian needs to close the day on June 17th at $45.10 or higher for the trade to be profitable, a gain of more than 18% from the current share price. If Rivian closes anywhere below $45.10, you'll lose money on your options. If Rivian closes at the $35 strike price or lower, your options will expire absolutely worthless. So I only need $10.10 to get started? Sounds great. Hold up. You can't buy an option on a single share. The market sells options in contracts of 100 shares. That means this contract will cost $1,010. 100 shares times $10.10. plus any broker fees. Robinhood doesn't charge for options trading, so their customers can lose their money faster. Have fair access to options trading. Even the more legitimate brokers don't charge much for options trading. For example, Schwab charges 65 cents per contract per trade. So when you buy this option, you're buying the right to own 100 shares of Rivian at $35 anywhere from now until expiration on June 17th for $1,010. In other words, you're getting the same amount of exposure $3,800 would get you for owning the actual common stock, except now you're paying less than a third of the cost. So how could this possibly go wrong? There are a lot of variables that go into making an options price what it is, and these variables are called the Greeks: delta, theta, gamma, vega, and rho. You can read more about them from Investopedia using the link in the show notes, but basically these Greek letters are what Wall Street uses to take your money. All of your money. And here's where it gets really fun. You have to be right about 3 different variables: direction, distance, and time. First, direction. You need to be right that Rivian will go up in value. If Rivian closes below the $35 strike price on your contract's expiration date, your money will disappear like a plate of brownies at a cannabis convention. Second, distance. In this example, you're betting that Rivian will increase by at least 18% by the expiration date. Let's say Rivian drops in price to $29.66 and then increases 18% from there. Sure, it increased 18%, but since 18% from $29.66 is $35, your options expire worthless. Third, time. Let's say Rivian reports another bad earnings report, not a totally unheard of event, and drops to $35 on Friday, June 17th, but Amazon announces on Monday, June 20th that it will buy Rivian for $150 a share, more than a 325% gain from your $35 strike price. Since your options expired on Friday, they're worthless. You were right about the direction and the distance, but you were wrong about time. In other words, there are a lot of ways to lose when it comes to options. Sure, if you owned 100 shares of Rivian, you'd be down $305 if Rivian closed at $35 on June 17th, but you don't need to take the loss unless you decide to. If you own the options, you don't have a choice. You'd be out your $1,010. The reason traders will say that options are cheaper is because you only had to outlay $1,010 instead of $3,880 to play your bet. Now, let's say you wanted a cheaper option to your $1,010 options contract. Let's say you think Rivian's going to see a huge jump in the stock price, like in a month. Instead of buying a contract expiring on June 17th, you could buy one expiring on April 14th. These only cost $6.70, or $670 for the contract, more than a third less than the ones that expire in June. However, you also have 2 less months before expiration. But that's too easy. Let's say you're a longtime member of WallStreetBets. In that case, you would probably bet options that are out of the money. Out of the money means that the strike price is higher than the current stock price. In other words, you need the stock to increase to a higher price just to break even before adding in the cost of the options. Let's say you think Rivian is going to pop to $60 by the end of March. Instead of buying the $35 strike call, you could buy the $50 strike call expiring on March 25th. Do not do this or anything you see on YouTube. And yes, this is investment advice. Don't do this. This option would only cost you 45 cents or $45 for the entire contract. Why is it so cheap? Because it's never going to happen. In addition to a wide variety of other variables, options are priced by the likelihood of the outcome. In order to just break even, you'd need Rivian to increase to $50.45 by the end of March, an increase of nearly 33% in a stock with no sales and poor execution in a bear market. For me, I think of long-term investing as a way to give money to a company that I think will continue to perform and increase its earnings into the future in hopes that it will share those earnings with me. I think of options trading as walking through the bad part of New York City at 2 a.m. in my underwear with $100 bills taped all over my body and a sign that reads, "Take a whack and win a free $100. That, and I've learned it's actually illegal for me to make money trading options. Either that, or I could just be really bad at it.